All right. So we are live. Uh, Gershie Vann. Did I pronounce? Is it Vann?
Van.
Van. CEO of Magma Capital Funds. Before we dive into anything detailed about the business or you, I'd love to learn what specific problem are you trying to solve or address when you started the company, and we'll go from there.
It's a great way to look at things, like through the perspective of what consumer problem you're trying to solve. I think that there's a very large shift going on inside of the active traded um, financial space. So you have like your conventional passive trading where you put money into an account, it follows some predetermined philosophy, and it just kind of sits there and grows over time. And then you have active traders who believe they can achieve some risk adjusted edge, by following some trading pattern based on some system. And I think historically, it was um, common to have a discretionary type approach where you would just people would do what they thought in their gut would happen that day, and a lot of that was due to like limited information available. But we're trying to capitalize on this trend away from discretionary trading towards systematic trading, and even beyond basic systematic trading, more towards machine learning, where you can synthesize and take in an enormous amount more information than you would have been able to under a discretionary or a traditional systematic structure.
And why would the discretionary or traditional structure not use as much data? So is it the data piece that makes it unique? So the technology to use enough data to make decisions?
Well, I think humans are like inherently limited in
Mhm.
how I'm not anti-human, but I think humans are inherently limited in like how much information they can take in and process and weight systematically. There's this anecdote that I like to point out that phone numbers, when they were originally put out there, had 7 digits separate of the area code, and even within those 7 digits, you usually have a dash. And the reason there were 7 digits is because the human mind can't memorize more than 7 digits. And so if you think about that, and then you try to consider a human trader who's trying to synthesize, let's say, 50,000 relevant data points, it's unlikely that they can do that and make an unbiased decision. Like there was a fantastic book called Thinking Fast and Slow about the heuristics and the biases that we use to kind of make decisions very quickly. Um, where what we do is we form like fairly simplistic mental maps to say like, oh, this is the solution to this problem, and as a result we make less precise decisions. So I think in an age of limited information, that was an okay way to trade.
Hmm.
And I think now, as our tools have expanded, there's this move to take advantage of that, because I think ultimately this is a better solution.
Hmm. Do you think the people who do individual trades without any sophisticated AI that they're playing a slightly different game where they're trying to internalize the human component of what's going on in the market? The externalities that data is not accessible to. Is that even a worthy way of looking at it, or is that just kind of hocus pocus?
Um, I mean, I think you can make a case that during times of market stress, a human would have a better ability to understand like what narratives are driving what's happening in the market, because we're humans,
Mhm.
and so we understand narrative, and narrative drives a lot of things. But I mean, you can train a machine learning model to start trading around narrative driven
Hmm.
market activity, and I think a lot of people are still doing that because that's how it's always been done.
Yeah.
But there's only a certain amount of time that you can keep going within that frame of mind before, like at the end of the day, if you have a classic discretionary trader and they're producing 800 basis points of returns, 8% per year, and then there's a systematic trader who's producing 1,200 basis points a year, 12%. How long are you going to continue to allocate to the discretionary trader? I think over the coming 10 years, there's going to be a very, very large exodus out of discretionary trading strategies.
Yeah, yeah, that makes sense. And paint the landscape a little bit for how you guys fit in. You started this company only a few years ago. What were you doing, or what did you see from, say, a 50,000 foot level that said, "I have to go and start my own company," and then catch us up to where you guys are specifically? Yeah.
Sure. So I've always loved systems and kind of understanding how people fit within systems. I think the idea that we as humans can invent like incentive structures, and those incentive structures can guide human behavior and thus make behavior predictable is like a fascinating phenomenon. And I think that manifests in macroeconomics in a really strong way. This idea that you can raise the cost of borrowing and naturally people will borrow less, and you can lower the cost of borrowing and people will borrow more. And all the while no one is aware of that whole system. I've always found just absolutely fascinating. And I wanted to build a model, a financial, a trading system that was built around that. Because if you build around macroeconomic principles, you're not subject to specific trends of the market. You can kind of make money in every trend. So in states of low, and that's what got me to focus on volatility,
Hmm.
because in states of low volatility, there's a certain way that you should trade. And in states of high volatility, there's an alternative way that you should trade. And so that's really what kicked off this thesis. And once I finished it, which was like around the beginning of 2020, I raised some seed capital to build the organization, really get it off the ground. Um, I think whenever you try to build a company, there's an enormous amount of work that's necessary to be done that exists completely external of the product.
Hmm.
And so, really having that seed capital, that ability to build that infrastructure was super important. And so, we launched in March of 2020, right before COVID. We started, and so we spent around 6 months trying to build out the product, build out the fund, and hire all the external partners that you need, banking, legal, et cetera. And then we started trading in the middle of September. We launched our second fund at the beginning of March of 2021. We have around 5 million in assets under management, and we have around 35 investors.
And why are they different funds? So we talked a little bit pre-show, but I would think generally it's people can invest in you guys, and then you take their money and choose where to put it. Are they
Mhm.
structured in different buckets or different funds for a reason? Or
So
what's the
the
strategy?
Yeah, so the different funds, they do follow different strategies, but I see it more as an ability to access multiple markets without the increased cost that you would get from launching your first fund. So, you launch your first fund and now you have access to a specific market segment. In the case of Magma, the first fund that Magma launched, we were targeting initially high net worth investors, individuals, and now we're moving into like the family office space, and the broader institutional space. And that's great.
Hmm.
But let's say your product takes off slowly in the institutional space. Can you potentially open up another product that's geared towards a different audience that can take off simultaneously without the same cost base as the first product, because it can feed on the existing resources? And so we launched a fund geared towards professional athletes.
Hmm.
And now we're in the process of launching our third fund, which is geared towards investors that want a much lower return, on let's say 5% per year, kind of like what you would have received in, say, 2005 or so off of a treasury, with a similar volatility profile to what a treasury delivers. Just they don't want that 1% return that a treasury delivers now. So I think this is a really brilliant time to be in the hedge fund space, because there is a need for, as interest rates have gone to zero and the returns of fixed income have started approaching zero, there is an enormous amount of room for innovation and for fund managers that are going to bring different ideas to the table. And so, I guess to directly answer your question, the reason you open up multiple products is because that increases your probability of success with a lower cost base per unit of success.
Hmm. Interesting. Interesting. So I want to get a better understanding of this, just for my own sake. So, do you know the numbers of how many traders there are, or hedge funds, or are there general numbers that you default to understand the size of the landscape, the number of people who are making investment decisions, or just the money that's floating around in the general market pool?
Yeah. So it's kind of paradoxical to say, don't quote me on this on a
Yeah,
podcast, right? But
I won't tell
but I think there's roughly 13,000 hedge fund managers across the US and the UK. And they're running about $4.3 trillion. And it follows like a classical distribution where the majority of the capital is run by a fairly small concentration of the managers. But that's broadly the size of the industry.
And is the concentration of the managers who have the most leverage, are they getting the best returns, or how is that? How would you say, if there's a way to access this information, but how would you say the returns are distributed?
So the hedge fund industry is not, I think from the outside, the typical approach would be, well, whoever has the best funds is the
Right.
best returns is the best fund. But hedge funds really serve a different purpose for different investors. There are hedge funds that target very high returns,
Mm.
but what you quickly become aware of is most hedge funds are targeting a high risk adjusted return, what in the industry is called the Sharpe ratio.
Mm.
And the Sharpe ratio is basically just your return per unit of volatility. Because basically, let's say you could double your returns, but you also doubled your volatility. Your return per unit of volatility or unit of risk has remained equal. So if you have a fund that has double the volatility, instead of producing 10%, produce 20%, well, you haven't really accomplished anything for your investor. Because from their perspective, you would have lost double the amount. So, it
Yeah.
goes both ways.
Yeah.
And so there's this focus on producing, let's say, funds that are beta neutral. In other words, they produce returns irrespective of what the market is returning, or funds that are more income funds where they want to generate a very, very consistent type of return. You can think of it from the perspective of, if there's most of the money in the markets is institutional investors. Again, don't quote me on this,
Hmm.
but I think this is the case. The largest allocators are pension funds, endowments,
Yeah.
that type of group of people, and they use hedge funds as ways to um, find vehicles that can um, serve to offset or be uncorrelated to the returns of the existing vehicles that they have. So, for example, if they're making investments in real estate, can they find another asset that's uncorrelated to those returns? If they're investing in the S&P 500,
Mm.
can they find another asset that's uncorrelated with those returns? And the same with private credit, with if they're going to invest in timber, if they're going to invest in forests or wine or art or anything like that. And what ends up happening is, in aggregate, you end up with a portfolio that's a lot more stable, because when one asset sinks, it is not necessarily the case that another asset will sink. So I guess what I'm trying to get at is that it is not necessarily the case that the largest hedge funds produce the highest returns, because that is not necessarily what the market is looking for.
Yeah.
Often the largest allocators are looking to the largest funds to produce very high risk adjusted returns, but their actual annual returns may be something like 8 or 9%.
Yeah. Yeah. That makes sense. That makes sense. Um, yeah. The highest returns wouldn't be where the most money is funneled, because of the
Mhm.
risk is going to be higher naturally. So I imagine if you were to break out the 14,000 hedge funds, there would be some that had tremendous returns, but they had high risk. And so that's not really a fit for a large amount of capital for like a pension fund or something. I have to believe, like, your thesis here is, it's hard to deny that just more data accessed, the more you have access to data, the more you can make better decisions. What's the tip of the spear now? Like, where are you seeing the data that you now have access to that wasn't available 2 years ago or 5 years ago? Is it like satellite data, or scraping Twitter data, or metadata coming from, like, where are the pipes? Where's the, like, pots of gold that people are kind of chasing after?
Yeah, I think what's really unique about like this time period is, um, beyond just data, you need actionable information, and in order to get actionable information, you need an enormous amount of like data streams. And I think previously you were able to access alternative data, but you might only get a few streams of alternative data. And so, like, let's say you wanted to gauge the sentiment of market participants, and maybe you would do that through aggregating news feeds. Well, maybe you didn't have the capacity to aggregate so many news feeds in real time. I think what's different about now is there's such an enormous amount of data pouring out of so many sources. Like, there's this line that data is the new oil,
Mhm.
um, and the entire economy is just going to run on this new form of information. Um, and I think the tip of the spear is definitely there. I think the most like excess returns that people are going to generate are going to be a product of getting to information that previously was inaccessible in a quicker way. And in so doing, the markets will become more and more efficient.
And what are those? I mean, is it satellites, or is it like, what are the
Oh,
actual?
I think this would be another example of where it really depends on what you're trading. Like, let's say someone is trading around an earnings season, and maybe they've been tracking the amount of parked cars in a Walmart. This is
Mm,
not something that we do. We trade the indexes, and through that, they're going to, or maybe they have some way to track the amount of foot traffic in a specific store, and they're going to aggregate that and then make some forecast about what a company's revenue lines are
mm,
going to look like. That could be one way of doing so. Another way would be aggregating news feeds. Um, there is some satellite data that I think people have used to kind of figure out cases in which factories are a fraud or otherwise. I think often their narrative is driven by, oh, like wouldn't that be cool if we could use satellite
yeah,
data, and then that becomes like what everyone talks about, but it isn't necessarily so useful. Um, I think that we're going to find that as we're able to harness more and more data, it will get more and more effective at telling us what we're trying to figure out.
yeah, yeah. Because really, when you say data is the new oil, what are we really saying? We're saying that understanding ourselves on a societal level is the new oil, and effectively, what you're able to use, like, what is the data, what is it an analogy for? And I think it's the understanding of where attention is going. So data is
Hmm.
useful for, because think about, the economy is largely driven and will increasingly be driven on attention. It's
Mhm.
wherever eyeballs are at, whether it's websites or mobile
Mhm.
apps or people on social media. The more eyeballs, the more time and attention you have, the more you're relevant. And increasingly so, people can monetize that, where traditionally it's been difficult to, and it's been centralized around,
Mhm.
ABC, NBC, like large publications. Now it's kind of
Mhm.
it's like a free for all for attention. So I think attention is the one limiting factor that each of us have a finite amount of every day. It's like
Mhm.
you're given an allowance of 16 hours of attention every day. And so the
Mhm.
data is like, where is that attention distributed? Because where it's
Mhm.
distributed is where people are going to spend money. And I think of when we say the data, we're trying to
Mhm.
know, if you take all 8 billion people, or say 4 billion people that are online, if you take that, how is it distributed across the different places they spend their time, their attention?
Mhm.
Um,
Mhm.
because that will tell you so much, right? I mean, it just
Mhm.
theoretically, if you had access, if you had the holy grail of data, which would be,
Mhm.
where is every person on the planet spending their attention at every given point, you could make
Mhm.
predictable decisions about pretty much everything they would do in their life, every buying
Mhm.
decision,
Mhm.
person
Mhm.
they would date or car they would buy. And I think that's a stretch to actually imagine it, but that's kind of like the pinnacle point of where it would be going. Like, because isn't that what trading is about? It's about trying to determine what's going to be more valuable tomorrow than it is today, like where the
Mhm.
trend is. I'm curious if any of this is making sense to you. I'm kind of spit.
Yeah, I think it does. I think when I think of this statement, data is the new oil, I think of what is the most valuable commodity without which the economy cannot run. And I think this echoes a lot of what you're saying, that in the past, oil was this commodity where if you don't have it, you cannot run your factories, you can't do anything, and so the whole economy shuts down, and you have like 1960s type inflationary crises, and we have to intervene in the Middle East, and yeah, it becomes a really big problem. And I think now it's just really transforming, where every decision made by every business will be based on an enormous amount of data, and like you're saying, as that data gets more and more granular, our ability to predict patterns of behavior will just soar. I think it is true to your last point that markets are fundamentally pricing machines. They're taking in information and they're pricing assets as that information dictates it should be priced. And so the quicker and more substantive you can make information flow, the more accurately assets will be priced.
And okay, so let's take that on board. So if assets are mispriced, that's an arbitrage opportunity, and then
Mm-hmm.
then a trader could come in and trade. But assuming
Mm-hmm.
assuming the end state, all the assets are perfect. So imagine you take those 14,000 hedge funds and we
Mm-hmm.
just transform them into one super AI that has access to
Mm-hmm.
every piece of data on the planet. At that
Mm-hmm.
point, the price for everything. I mean, even when we say everything, like what's the limit of the things that we're talking about? Like where can you, let's maybe we'll just start with you and Magma. What are the limits to where you can distribute funds and take advantage of this arbitrage through having access to data?
Well, so at the moment, we only trade the S&P, the Dow, the NASDAQ, and then along the treasury yield curve. So short-term, intermediate, and long-term treasuries. So in any instance, when we believed the price of one would rise, that would be what we would allocate to. Although, like one thing I would say is it's based on an optimization of past behavior. So it's not we're not necessarily making predictions about what this asset will do today. It's more we're saying this is the environment we believe the market is in today, and this is the allocation that's optimal for that environment. Um, but I think if I'm following your train of thought correctly, what you're saying is there an endpoint at which everything is priced perfectly, and at which market activity to some extent kind of ceases?
I think of it as like as pricing becomes more efficient, uh,
Mm-hmm.
there's less of an opportunity for traders, individual traders. It becomes
Mm-hmm.
more centralized because it becomes more of a commodity.
Mm-hmm.
It's like the marketplace becomes more transparent, and so there's not as much inefficiency or opportunity for people to come in
Mm-hmm.
independently and provide value by increasing the efficiency of those prices. So
Mm-hmm. Mm-hmm.
I think the next phase is that bam, there's a new market, and then all of a sudden there's
Mm-hmm.
incredible inefficiencies, and I think that that's largely the world of crypto. I think it's the
Mm-hmm.
world of NFTs, or it's the world of in the future maybe VR, or even things like
Mm-hmm.
how do you price externalities of uh, driverless cars and
Mm-hmm.
transportation flow. Like that's a whole market in and of itself that we haven't even opened up yet. It seems to me that, and tell me if you disagree with that, that the Dow, the Nasdaq, the top 1,000 companies traded, everyone has access to the same information. Maybe there's some slight difference with how fast the information comes, and some traders specialize in ultra uh,
Mm-hmm.
low latency, high latency trading. But for the
Mm-hmm.
most part, everyone has access to the same information, and I think
Mm-hmm.
that kind of compresses any differential returns. Um,
Mm-hmm.
yeah, I don't know if you'd go somewhere with that, or what your reaction.
Yeah. I think it's a really good point. One thing though is the amount of information is just enormous, and the ways that you can trade on that are so varied. So I mean, like let's just imagine that there are going to be a couple billion, Internet of things devices that are going to be attached to
Hmm.
every conceivable appliance. So now the I mean, let's just imagine that every Gatorade bottle in the world sent a signal to some central hub or some data source that it was being drunk and the rate at which it was being drunk. Um, well, now, like the possibilities for trading become more and more and more finite. That also means that the market becomes more and more stable, and so now the capacity of the market to grow, to attract more capital, rises. Its ability to have a larger amount of leverage rises, and also I think we've only kind of scratched the surface with public assets. Like even let's say real estate, if you want to get exposure to real estate, you're going to get exposure through some sort of REIT that owns like a bunch of like sub properties. But I think there's a world in which every asset with some value could be a publicly traded liquid
Hmm.
asset. I mean, like public equities are quite valuable. I don't know what the S&P is worth now, something like 40 to 45 trillion dollars. Um, but there's an enormous amount of other US and then international assets that currently aren't liquid, and you have to have quite an infrastructure just to access those assets. So crypto is kind of this like
Hmm.
area that's just burst onto the scene recently. But even amongst like hard assets and cash producing assets, we can, I would imagine, over the next 100 or so years, we're going to liquefy every asset. There's no reason why an enormous amount of assets right now can only be accessed through the private space. Like through, you can only get access to, let's say, buying certain real estate if you don't want to directly buy it by accessing some fund. But I don't know that things have to stay like that. I think Like I'm in Willis Tower right now. I think Willis Tower could become its own equity, and it throws off a certain amount of income in the form of a dividend of sorts. And it gets publicly traded, and people buy and sell it based on whether they think it's going to rise or fall in value. And now you have downtowns all over the entire world where every substantial asset becomes liquid. And then farmland becomes an asset that can be held in a liquid sort of vehicle. I think we're very, very far away from this like perfectly efficient frontier. And then the last point I think is that there are currents that drive the pricing of assets external of just what is the optimal pricing for that asset. So I mean, fear is like a great example. When people are scared, they pull their money out of assets, and that causes a mispricing of assets. So even if you have the ultimate AI, there's still a limited, like you can still have instances where where you will have a structural dislocation in the pricing of the market that will allow an opportunity for profit.
Yeah, great points. Going on your first point, what stands in the way between society becoming rapidly progressing down this road of not liquidizing, liquid? It's not even liquidating.
Liquefying.
Was that what would you call, like, say the building right
I
now
think so.
is owned by probably a handful of people and is probably owned
Hmm.
by some LLC, but they have the regulatory capability today to just throw it on a market? And is there a technological barrier or is it a regulatory barrier? I'm skeptical a lot of real estate because I feel that it's entrenched in regulatory. It just has barnacles all over it that just prevent people from being creative on real estate. And I think that's what drives a lot of the high prices in some cities and the low turnover, and kind of present it's almost like if you imagine your body, it just has it's built up clogs in the arteries, and we have a
Hmm.
far from fluid system. And
Hmm.
I mean, I'm certainly a proponent of reducing the amount of regulation in real estate, but I'm wondering if that's real, if I'm looking at that correctly. Is that really what prevents progress in this direction, or do you see it another way?
I mean, I can't speak on this with like any authority. This is something
Yeah,
that in
yeah,
the back of my mind, at some point, I'd love to participate in the creation of this. And I'm sure there are plenty of entrepreneurs that are working towards this. But ultimately, if something is profitable and if it's in the best interest of people, it will be done.
yeah.
And so I do think at some point, real estate will become a liquid asset. Um, I think infrastructure is the next big opportunity. The thing is, like, as we age, we're an incredibly wealthy society, and as we age, there's more and more capital that accumulates that needs to be put to work in assets. And I don't think we've done a very good job at like generating more assets that can throw off capital, and that's not great for uh, pensioners.
Mm.
And we're gonna have to get used to a reality where there's hundreds of millions, if not billions, of people around the world that are over 65 that need income. And so it seems to me to be an obvious solution.
Are you implying that the people over 65 haven't saved enough money in their life, that they've sort of mismanaged their finances throughout their life and they don't have enough to live through the remaining retired years that they have?
No, not at all. I mean that if let's say there were assets that used to produce returns of 4%.
Uh-huh.
And so essentially you would need to save, let's say you needed $1 million a year to live your life. That's a high number. Let's say you needed $100,000 a year to live your life. You would need a quantity of assets where that 4% would throw off $100,000 a year. So you would just need 25 times whatever your principal would have to be 25 times that 100,000. So 2.5 million. But if everybody starts piling into those 4% assets, and now as a result, the price of that asset itself rises such that the return is only 1%, well, now you need 100 times.
Mm.
That's not because that's because there's not enough assets,
Mm.
not because there's anything like not because there's anything that anyone is doing wrong.
Yeah.
Like I think to throw this back on pensioners and say, well, you didn't save enough because now you need to save 100 times your principal instead of like 40 times, or 25 times. I think that's just us not being creative enough.
Yeah. Another way to say this, right, would be that the return on the investments, the reasonable, accessible investments, are lower going forward. So, would
Yeah.
that be to say? So, another way too to internalize this is people are producing less productive companies than they once were, and right,
Ooh, I'm not sure that that's the case. I think it's just that the scale, so let's imagine that the world starts off with $1 million, and there's only one asset, and that asset throws off, I don't know, $100,000 a year. And then the next year the world has $2 million, but there's still only one asset that throws off $100,000 a year. That asset, since it's the only thing that can be purchased, will just double in price. So
Mhm.
the solution is not to ask everyone to save more to deal with that rising asset price. It's to introduce more assets. And right now, the assets exist. They just are basically only accessible to certain groups of investors because you need a whole operation to get access to a lot of these investments.
Mhm.
I think a world where you could gain exposure to real estate by buying individual properties, and you could gain exposure to real estate, like fractional shares of individual
Mhm.
properties, and you could gain exposure to, I don't know, litigation finance, music, art, wine, etc. Um, I think that would be a much cooler world.
Yeah.
I think you'd have many more uncorrelated asset classes. I think we would be better able to absorb the increase in capital that will inevitably come with future growth.
Yeah, and it also incentivizes people in each of those areas, whether they're developers in real estate or musicians or artists, to make more things, make more valuable things, because there's much more liquid market accessible. If I could go and make a song and bam, I can immediately sell ownership rights to 3,000 people, and the
Hmm.
market is just worked out electronically, automatically.
Hmm.
That's way more exciting, right? Because now you can have more musicians and more artists and more developers doing things. It's in a way, I think of it as like being stuck when you only have a limited number of participants in the market out of your total
Hmm.
potential market size. It's like, yeah, you sit down and you have probably more than the average person, or maybe even just as much as the average person in terms of the options you could invest your money. And
Hmm.
I find that one totally ironic rule that the government put in place was the rule of the accredited investor. So you have to have,
Hmm.
in order to invest in startups, in companies, what's the rule? It's like, in order to make private investments into private companies, you have to have greater than 200,000 in annualized income or a million in net worth. And for most
Hmm.
people that are, in their teens and 20s, that want to make these investments and take on high risk investments, they can't do it because they don't qualify. And it
Yeah.
precisely does the counter to what it's intended to do, which is to protect people from making bad investments, which that never rings logically to me. It's like, what are we doing? We're saying that the government has the ability and right to say what you are qualified to do in terms of make your. I mean, if you want to spend all your money on a startup, and like, why is that wrong? I just don't understand a lot of the methodology deployed.
Well, I think the counter to your point is that ultimately, if an individual goes bust, they run out of capital, they run out of money, they fall on the state. And so the state could make the case that if you don't have a certain amount of money, such that if you made a bad investment, you would then go broke, we're going to limit the amount of upside that you can have, and we'll also limit the amount of downside. It's tough because, like, if you're right, a lot of the opportunity in the investment world exists in the private placement sphere, and in order to be part of a private placement, in order to buy into it, you have to be an accredited investor. And that strikes a lot of people as unfair, and I get that. And it's also annoying when you're raising capital because now, the quantity of people that you can raise capital, it's only like 10% of America. Um, so that's a frustrating component. But then on the other hand, I mean, if there is someone who's very wealthy, let's say they're worth $10 million and they lose $200,000 in some investment, maybe they'll be frustrated, but it's not the end of
Mm.
their life. If someone makes an ill-informed decision to invest in some product and they took their entire life savings, which amounted to $75,000, the public uproar is substantially
Yeah,
larger.
yeah, you're right. I mean, ultimately, the government is has a financial relationship with each person, and so if you run out of money, you can go to the government and they will, you can declare bankruptcy and write off debt that you have. So, yeah, I mean, I understand. I get it. I understand it. I don't love it, but I get it.
It gets really tricky. I think there was an attempt to like, you know, um, to modify the rules somewhat by allowing, certain people who weren't accredited investors to invest in crowdfunding startups. And I know there's a lot of companies that are doing some work in the space. Um, it's very tough though because like w- I think humans instinctively like root for the underdog, and in any relationship, if someone is like, let's say, monetarily disadvantaged, they're going to be the underdog. And so do you want to put people in a position where they could, a lot of private placement ventures do go under, and do you want to put people in a position where there's almost definitely going to be a certain amount of people that will go under? And I mean, you can see they're like classic newspaper type headers,
Yeah, yeah,
retiree in nursing home loses X number of dollars to
yeah,
whoever.
yeah,
It doesn't make for great optics.
yeah, yeah. You're right. You're right. What are the kinds of things you think about when you run Magma on a day to day? Like, what was your morning like today or yesterday? I mean, what are typical when you're operating at your peak performance? What are you doing?
Um, it's a really good question. So I think it's some mix of I really believe in building a company where everyone's doing the thing that they're best at. And so like I'm pretty good at ideating, if I may say so myself, coming up with new ideas, getting around problems and that type of thing. And so I love the meetings where um, we can discuss walls that we're running into and ways to get around them. And I'm terrible at operations, and so other people within the team handle those types of things. I enjoy business development. I enjoy meeting with clients. Um, it really depends on the day. Some days, every day has a different kind of set of meetings and has a different set of goals. I think probably like most CEOs, there's no fixed role. You kind of need to be whatever the company needs you to be at that moment. And if that means that you need to source talent, then that's what you do. You source talent. And if that means that you need to raise capital, you raise capital. And um, you're always kind of pivoting to whatever the situation demands of you. So I guess peak performance and like flow state comes when I can do that effortlessly. And that's when it's a lot of fun. Otherwise, it's a little exhausting.
Yeah, yeah. Well, let me ask you. That's a good answer. Let me ask you slightly differently. Like, if you think of it instead of you, but you think of Magma as the company, when Magma is operating in its most unique and differentiated way, how is
Mm-hmm.
it? How does it stand out? How does it? What's the thing that you want to carve out and say we want to be the best at this specific function or vision?
Got it. I think there's a huge emphasis that we push on collaboration and on iterating relentlessly, because you're never going to reach perfection, but it's far more likely that you're going to get there if you're always learning from your mistakes and kind of building on that. I think there's this misconception that the best way to generate outsized returns or to build an incredible product is to find someone who's a genius and to put that person alone in a room and say like, here, you figure it out. I actually think that's a terrible way to come up with really good ideas. I think we mythologize um, individual genius, and I think it's like unbelievably rare.
Mm.
I think for the most part, if you want to get to something that resembles brilliance, you need a team, because collective intelligence is just a lot smarter and broader than like narrow intelligence, like a single person. So I would say that's what helps us stand out. I think a lot of hedge funds have a little bit of like a silo mentality where it's like you do this, you do this, you do this, and there's no talking between the different departments. For one, I think that like crushes the human spirit.
Mm.
I think people thrive on talking and like working through their problems. Um, and we've embraced the exact opposite approach where every meeting that involves ideation that isn't, let's say, that isn't private,
Hmm.
then you're welcome to it. You want to come in and you want to participate in some way or another, by all means, please do so.
Yeah.
And I think that it's a little bit Socratic, where like you put forward something, you get challenged on it, you innovate on that. I think that's where allowed we've been able to accelerate our innovation cycle beyond what would be the case normally.
Mm. So specifically, just so I understand, when you are thinking about distributing a portfolio in a fund, is it a combination of? I mean, I would imagine it works something like this, but tell me how it actually works. You have a team of researchers. They go and they get a bunch of information and a bunch of data. Maybe they draw up a thesis or some overarching ideas in different sectors about where they think opportunity is or won't be, and then you have a team meeting. You discuss it. You try to throw devil's advocates and try to pump it up or knock it down and come up to a more sophisticated viewpoint on things. And then you say, okay, let's throw in, you take some combination of quantitative and qualitative analysis and say, let's put in X percentage of our portfolio in this area. And then that's how it works. Is that, am I close on that? I really, I don't know a lot about this world. So I'm just trying to learn.
I think no, I think it's an admirable stab. I think that you start with the most important thing in any machine learning model are the features. So how do we? And features are essentially data points that are predictive for whatever it is that you're trying to predict. Maybe you're trying to predict what percentage point will the S&P move tomorrow. So you now want to go and find features, predictive factors over some time period. Maybe it's a day, maybe it's a certain volume block, a certain dollar block, etc. And so now you have to be really creative in how you test for that. You need to build the infrastructure for it, and you need to think both quantitatively and qualitatively. Where am I likely to find that information? Is it in is it through natural language processing in I'm blanking on the word, in sentiment data,
Mm.
or is it going to be in volume or pricing data? And then you test for that, and then you say, okay, well, if you're having trouble finding that, do we approach this problem some other way? If you then complete building a model, do you stop there, or do you build multiple models that are uncorrelated with one another, such that the mistakes of a single model are not necessarily mistakes made across the board because the other model could have made a different decision? Then you might innovate from there and say, okay, well, um, we may now just be going long and short our optimal bet. Do we want to switch things up and introduce some other variable that would allow us to reduce our movements relative to the market? So it's more of like it's more of this like endless attempt to get towards where you're trying to go. How do you continue increasing your returns relative to risk? How do you continue reducing your movement relative to the index?
Mm.
I don't know if that answers your question.
Yeah. And is it clear the mechanisms for moving in that direction? Like it's a process you have internally of,
Not really.
yeah, it's more,
It's very
yeah.
organic. I actually think predefined processes are really they kind of trap you.
Yeah.
It's very healthy, I think, in a creative process to not have some preordained. Like you want to know broadly where you're headed, um, but if let's say like what we like to do is let's say there's three possibilities, three possible approaches to get to where we want to go. You have three researchers, each starts out on their own path, and then when you start seeing which path is most probable to be successful, you pull the other researchers onto that path as well. And so you can both increase the amount of possibilities that you can test and also accelerate the amount of time it takes to complete a project.
Mm. That makes sense. It's a good answer. Last thing I want to ask you, because I'm so curious to hear your thoughts on this. I think a lot about this phenomenon at large, and it certainly is most typically applied in the financial sector, which is Nassim Taleb's famous idea of the Black Swan. And
Mhm.
if you kind of abstract out what that's getting at, it's highlighting this seemingly like human psychological bias or maybe cognitive bias or flaw, which is that we look at other people as signals for what's true, and
Hmm.
we try to weight the people that have the most reputation, and those maybe researchers or academics or doctors in the case of medicine, and but they each look at each other as well, because
Hmm.
maybe they're each not doing the actual work, like say climate change, for instance. How many people are going to the North Pole and drilling samples and looking at it?
Hmm.
A fraction of the actual people in that whole domain.
Hmm.
All the climate scientists. Um,
Hmm.
and so I think if we put a lopsided amount of trust in a tiny fraction of people who do the work, then we're so dependent on them, and that work can be a proxy for pricing something or making some prediction about the future.
Hmm.
And I see many scenarios throughout history where that's been wrong, where it's like 99% of
Hmm.
the world viewed something and was absolutely certain of it. And that
Hmm.
ended up not being true, whether it's Newtonian physics or the world being flat. And there's
Hmm.
many examples of that. And I wonder what are we currently in where are we currently in one of those holes? Like where are we? Is it? And one of the areas where I don't know if this is it, but in the financial sector, I think could be like, are we collectively like, does the balance sheet of the country line up? Like, are we kind of, when we issue 6 trillion in free money, are we kind of all as a herd running off a cliff, and no one is like checking the books of the big guy? That may be one. I don't feel like you have to go down that road, but if there's something that comes to mind, I'm so curious. Um,
Hmm.
because I have to believe
No, it's
something is there's got to be some scenario where we look back in 50 years and we say, God, can you imagine everyone in 2021 was believing this and it turned out to be false?
yeah, man, that's a really good question. Um, yeah, I think the bias is that the whole like origin story of the Black Swan is that because there were only white swans around, everyone assumes that there are no black swans, but it turns out there is a black swan, you just haven't seen it. And that's like a cognitive error that we make all the time. And I think in the case that you're talking about is basically if we all collectively decide that um, running huge deficits is okay, then everyone is like, okay, fine, I guess it's okay. Even though a couple years ago, the consensus was that that's not the case. I think that there's a lot of things going on at the same time. Firstly, I think we need to acknowledge that absent the federal government, 2020 would have been really, really, really bad economically. I mean, the idea that we could go through a pandemic, um, and what portion of the country was unemployed at one point? It was like 15% or so. And yet the average person could walk out with more money at the end of 2020 is a staggering reality. It's like this like incredible movement of capital from the government towards the private consumer that allows demand to stay up and allows for the economy to heal in a much quicker way. And there's something noble about that because there are people, there are the human citizens that live their regular lives and depend on those paychecks, and their lives will change in a real way because of those actions. So I think that kind of started this massive stimulus check, like passing that as something that's okay. Um, Now, I think where you run into a challenge is okay. How long can we continue to do this? How long can we run deficits that exceed our growth rate? Um, because I think like academically, it's fairly proven that you can. This may be a somewhat controversial statement, but I think academically you can run a deficit that's equivalent to your growth rate with no harm to the economy, pretty much in perpetuity. So I mean, and you can think of it in like the context of a household. If a household was growing, even though governmental debt and households do not work the same way, and people like to think that they do, but for the sake of simplicity, let's just assume they work the same way. If a household grew their income by 3% each year, they could afford to tack on an extra 3% of debt each year because they could afford those extra interest payments. And so that's the basic theory behind why you can run a deficit that's equivalent to your growth rate each year. And it's important also to remember that we look at deficits and we get a nominal number. And when you look at growth rates, we get an adjusted for inflation number. So let's imagine that real growth rates, real GDP growth rates are 2%, but there's also a 2% inflation rate. So now you're at nominal growth rates of 4%. That means you should be able to run a deficit of 3 or 4% of GDP. I'm not a macroeconomist, but I can't understand why that isn't true. So it seems to me to be true. Now, can you then extrapolate and say, therefore, it's okay to run 7 or 8% per year? That to me doesn't seem likely, especially if you are not investing in the country, but rather spending on projects that are more exciting at the moment. It does seem like you can run up quite a large national debt without causing a crisis. I mean, Japan's federal debt levels are something like 250% of GDP. We're at like 105. So we can spend for quite a bit before, we run into any real issues. But it's definitely not a healthy route. I think like we've learned over the past year that we can spend far more than we expected. And that's a very important tool to have. But it's not a great position as a government to be in, because basically, if we want to be able to spend what we need to spend to take care of the populace, to have an $800 billion a year military and to run Medicare and Social Security and all of these programs, we really can't have interest rates go up beyond a certain number. And that penalizes lenders. And so now you end up in this like vicious cycle where you can't raise interest rates beyond a certain number unless inflation happens. And so things get like a little messy.
Yeah.
Um,
Well, I almost view
I'm not sure
like,
if a good answer to your question.
man, I don't know if this is what you're implying, but I see it different. I mean, when I look at Japan and say 250% debt to GDP, I don't see the story as being over. Like, yeah, I don't think you can draw any conclusion about that. And even the story with the U.S., certainly there would have been a lot more financial hardship in 2020 and 2021 if there hadn't been government intervention. But maybe it'll be worse given that they have. It's like maybe it's delaying the inevitable and making it worse. It's like, you can pay the price today, or you can pay the price times 10 tomorrow, kind of thing.
Yeah, I'm not sure I believe that. I think there's a few reasons why I would push back there. One is, what would you rather have? Like a maybe bad scenario in the future, or something that will solve the present problem? Like, the premise of the argument is that it is possible that in the future we may have a really bad problem. Yeah, I'll 100%. It's possible in the future we may have a problem. But the fact is, like, right now we have like a really, really, really big problem, and we have a way to solve that. So that would be my first push. And my second push is that the economy is like this web of connections. It is driven by these assumptions of valuations that are the basis for debt and everything like that. And so if, let's say, you go through some deflationary spiral and you say, well, we're going to allow all of these people to, be unemployed and have no capital to make purchases. Well, let's just use like a very simple, isolated example. Let's say that let's say 10% of people could no longer pay rent. Well, if 10% of people could no longer pay rent, then you'd have to devalue all of the real estate that catered to those people. If you devalued all of the real estate that catered to those people, now you have a massive hit to the valuations of those properties. And now the equity and debt holders of those properties take a very big haircut. And that spirals on, because now the equity holders who previously were making X number of dollars per year make substantially less. They spend substantially less. The banks that previously had a certain amount of money on their balance sheet no longer have it on their balance sheet. And then it goes on and on and on. And then you end up with like a Great Recession type, the Depression type phenomenon, where the cycle, the deflationary spiral just doesn't end. It's not the case that, like, I think the argument that's typically made is maybe there was some healthy type of, fire that should have burned up all the crap. And if you did that, then things would be healthier. But because everything is so interconnected, I don't think it really works like that. So while I agree that there is moral hazard present to bailing out a lot of things and to making debt very cheap, I don't know that the solution is to allow the edifice to burn to the ground.
Mm. Yeah. Yeah. Well, I agree. If there's ever a scenario where you're saying something, an economy is burning to the ground, then implicit in that phrase, anything is better. So if there's anything better than burning, so I'm in Tahoe now. We were talking about this pre-show, but the way forest fires are interesting
Yep.
by analogy to the economy because they go through boom and bust cycles. There's a lot of growth.
Hmm.
The forest grows, and then it starts to wither. There's die. There's accumulated death or fuel in the
Hmm.
branches and the leaves, and then there's a forest fire that comes through, and
Hmm.
that is a that's the natural process of things that has evolved in this
Hmm.
planet. And there's
Hmm.
pine cones that need the heat from the fire to grow, and the
Hmm.
forest has varying levels of trees. They have small trees,
Hmm.
medium, and big trees, and
Hmm.
that diversity in the forest prevents it from being completely annihilated in an absolute
Hmm.
inferno. And
Hmm.
the way that you mess up that system is that you prevent small fires from happening. And so we just
Hmm.
had one here a few miles from where I am in South Lake Tahoe, where it just wiped out 100,000 acres. Now, this is not
Hmm.
a naturally occurring phenomenon. This is largely from the fact that we have prevented forest fires from happening. And
Hmm.
so the fuel has
Hmm.
accumulated so much, it wiped out all the small and medium sized trees. And now you have
Hmm.
just big trees and no trees. So then you're going to
Hmm.
have, now we have to go through and kind of interject more into this situation. And I almost
Hmm.
think that by analogy, the economy works beautifully if you don't try to tweak it, because like you said, it's made of an innumerable interwebs and complicated externalities you can't possibly think of. And if you
Hmm.
have a naturally occurring forest fire in the economy, so yeah, some people lose their homes. They might have to go back and live with their parents. But for the most
Hmm.
part, we get through. And there's still
Hmm.
diversity of financial capabilities. The mechanics are still there. We're certainly not burned to the ground. I think the
Hmm.
scenario where things burn to the ground is when we intervene in a way where that cycle of setback can't happen.
Hmm.
And then it's analogous to the bubble. The bubble gets bigger because there hasn't been a
Hmm.
deflationary period. And then it's like,
Hmm.
and then it just collapses. That's how I just kind of conceptually do it.
Yeah, yeah,
The
yeah.
debate really is whether, like, what categorizes this implosion or explosion of the bubble. Like, how do you?
I think anytime, so like, I think we agree on this. I would also agree that local recessions shouldn't be interfered with. Um, but whenever you have like a complete seizing up of credit markets where good businesses will die along with bad and the ripple effects are just catastrophic. I think 2008 is a great example of that. I think COVID is a great example of that. I don't think there's any option other than the government and the Federal Reserve to serve as like a backstop.
Mm,
Um, I mean, we've had plenty of recessions. Like, I think,
mm,
in the aftermath of the .com boom, where you had this, like, this burst and enormous amount of equity value lost, and there was no national bailout of sorts, and I think that was healthy and that's corrective. And I think similar things happen throughout history. Can't remember all the dates offhand, but there's a difference between like something that's more local, where you have an expansion of the credit supply and then a contraction of the credit supply, and that's healthy. The Federal Reserve raises rates, and lending slows, and so on and so forth. And then you go back into and people that are over levered and that aren't actually producing value get kind of winnowed out, and then the economy continues to grow. And of course there are like knock-on effects where unemployment will go from 4% to 6%, and that's healthy and that's fine. But I think any situation where unemployment would go from 4% to 17%,
mhm,
now you're talking about the type of upsetting that can bring about the collapse of society. I mean,
mm,
you can't have 20% of your country unemployed.
mhm.
That's like a really, really big problem. Now you have like a social phenomenon on your hands that
Yeah, yeah.
it's a fire that you don't really want to play
Yeah,
with.
yeah, yeah, yeah. There are other. It's not the forest analogy is limited because trees don't protest and overthrow governments. It's like
Yes, exactly. There's always there's and it's not an exact science. Like, that's one of the reasons I think economics is so interesting, because it's not like we know this is exactly what's going to happen. It's inextricably linked with human behavior. And so there's this like yin and yang, and there's this there's this beautiful word that George Soros has. There's this reflexivity where both um, the economy influences human behavior influences the economy. There's this like back and forth that doesn't exist in many other spheres. Um, and so it's a hard
Mm.
question to answer.
Mm.
But I think it's really cool.
Where do you learn? Who do you follow? Is there resources, books, or people that you tune into that to learn some of this stuff?
Um, I mean, I like to read pretty broadly. I like a lot of books that explore the human component of finance.
Mm.
So William Bernstein's written a bunch of really great books like Delusion of Crowds and is it The Finance Cure or something? Adam Tooze wrote a bunch of books about um, he wrote a book called Crashed, and he just wrote a book on that was about the 2008 and kind of like the decade that followed. He does a really good job charting how the rise of populism is linked to a lot of the instability that people felt in the aftermath of the financial crisis. Um, he also just wrote a book on COVID.
Mm.
I think I literally received it this morning from Amazon,
Nice.
and about its like effects on the broader economy. Um, there's a lot of fantastic authors that because I don't think you can get away from the second you start thinking that it's just statistics and
Yeah.
it's just a bunch of numbers, then you build collateralized debt instruments that blow up the entire world economy.
Yep.
You start forgetting about the fact that there are humans at the root of
Yeah.
this.
It's really an
Um,
organic system. Yeah. We're not
yeah.
we're not a machine. We're not a computer at large. I mean,
Hmm.
it becomes increasingly difficult to produce predictions of the future that are reliable when you have more people involved.
Hmm.
Yeah,
Hmm.
yeah, yeah.
Yeah.
Gershie, I really enjoyed this conversation, man. Congrats on all the progress at Magma, and consider us an ally. If there's any way we could help at Around the Coin, or I could, let me know. But awesome conversation, really appreciated. You really do have a knack for ideating and thinking carefully about complex problems. So I enjoyed it. It was fun.
Thanks, Mike. This was great. Yeah, it's really nice to have a more free flowing, narrative driven type podcast. I think it's great.
Yeah, yeah, awesome, man. Well, have a great one.
Thank you. You too.